Now that Congress has passed the debt ceiling, stocks rallied into the end of the week last week. But where are we going from here? What do the bulls and the bears think is going to happen to the stock market next? As we expected, the debt ceiling talks ended up driving the stock market action last week. And when Congress ended up passing the bill Thursday night, stocks rallied into the end of the week in a big way. Adding even more fuel to the stock market rally fire was the Labor Department's non-farm payroll report on Friday. The report showed that the economy added 390,000 jobs in May, when Dow Jones economists were only expecting 180,000. So that kind of a beat really shows that the job market is strong right now. The bull case for the stock market next week is now that we have the debt ceiling behind us, there's nothing preventing stocks from rallying. And anybody who was nervous going into the end of May is now going to pile into stocks because they were holding off in fear of what might happen with the debt ceiling talks. And between the strong jobs report that came out on Friday, combined with Lululemon's outstanding earnings report, it looks like the economy is strong, with both the job market seeming resilient and the high-end consumers still buying. Many bulls believe that when the Federal Reserve meets in 2 weeks, that they will actually pause and not hike rates as they wait to see what happens from the hikes that they've already done going into this. The bear case scenario for stocks next week is that the market is pricing out a debt ceiling crisis that it never actually priced in. In 2011, when this happened, we actually saw the stock market sell off almost 20% in a number of weeks, and we didn't see anything like that going into the debt ceiling talks this time. While Lululemon is showing that the high-end consumer is strong, Dollar General and the rest of the dollar stores are actually showing that the low-end consumer is actually weak. In fact, the low-end consumer is trading down from Dollar General stores to food banks. Additionally, most bears believe the Federal Reserve will hike interest rates at their next meeting in a few weeks, and that they will not pause. I spent last week taking profits in a number of my different positions, and I always hate taking profits. I'm a long-term investor. I'm not in here for the small moves. However, the combination of seeing a rally as big as we saw last week, combined with the fact that at least a few of my positions, Apple and Nvidia, outgrew the target allocation size for my portfolio, meant that I had to take profits. No matter how much conviction I have that an investment of mine is going to head higher, my discipline has to take priority. I have to take profits when a position grows to be so large that it is outgrowing the rest of the portfolio. As I like to say, you have to take profits when you have them. Otherwise, the market will take them from you. It's important for me to always worry about the direction I don't want the market to go. If I'm long in stocks, that means I should be bearish. I should be worried about the bear case scenario, not what will happen if my stocks go up in value. If I'm wrong about my bearish thesis, it means I'll make money because the stocks went up. But if I'm right about my bearish thesis, I need to know where I'm going to add to positions and how much I'm going to add on the way down. For me, it's important to make that buying plan in advance. That way I don't have to worry about the emotion of an epic sell-off taking effect and making me second guess my decisions. My plan is already made back when I wasn't emotional and when I could be logical about it. To learn more about long-term investing and to follow along in all of the moves in all of my portfolios, check out my website, getirked.com, which is always 100% free. Please hit like and subscribe. It really does help the channel out. And I'll see you in the next video.